take a look at some earnings from Dangote Cement. Full year 2024 earnings released Friday, Saturday-ish. 3.5 trillion naira in revenues there, 62% growth. Cost of sales, though, rising by a higher print at 63.5 to 1.6 trillion. Gross profit, almost 2 trillion, 1.93. FX losses at 92 billion. Operating profit, 1.15, a 56% jump there. Profit after tax climbing by 10.4% to 503 billion naira. Going to dive in to the numbers and also talk about the industrial goods sector with Abigail Alabi, who, of course, Sub-Saharan Analyst of industrial goods at Vetiva Capital Management. Abigail, good morning to you. Thank you so much for joining us. Good to see you again. I think I should be saying Happy New Year.
Yes, same to you. Happy New Year.
All right, so starting with the revenues, I guess, what do you make of the revenue performance for Dangote Cement?
So, revenue was quite strong for Dangote Cement, and for the Nigerian operations, volumes increased by about 8%, and that also caused, we also saw price also increase significantly too, and that caused revenue to increase by about 69% to about 2.1 trillion. But we saw the opposite for the Pan-African segment, where volumes declined by 8%, but we saw that pricing was able to mask this volume decline, and we saw revenue increase by 1.48 trillion. And so we saw that group revenue also increased by 62% to about 3.5 trillion. So I can say the revenue growth was quite, strong for Dangote Cement for full year 2024.
Fantastic. And I'm glad you mentioned the Pan-African and also domestic sales. So let's just dig a little deeper into that. So if we go further into the revenue breakdown, so I guess, yeah, as you just mentioned that 2 trillion for Nigeria, exports 128 billion, Pan-Africa domestic 1.3, exports 1.4. What can be said about the revenue diversification across Africa for the company?
So I'll say Dangote Cement has showed strong growth in both segments, both in Nigerian operations and also in the Pan-African operations. And so far, they have showed a good balance of revenue diversification. So 60% is from Nigeria, and about 40% is from the Pan-African segment. And this diversification is very, very crucial also to the fact that it can help mitigate against the dependence on a single market. And we have seen that significantly affect certain companies as well. But Dangote Cement has been able to mitigate against this, but also pivoting into other markets as well. And at the same time, it also helps to mitigate against the challenges that are very prevalent in its home country, like inflation, foreign exchange valuation crisis, and all of that. And at the same time, also tapping into the growth that we're also expecting to see, what they're currently seeing right now in the African market. So I think it's a win-win on both sides.
Speaking of which, what do you make of the announcement to spend about $400 million to expand operations in Ethiopia?
Okay, so right now, Ethiopia is currently having an infrastructure development, or we are seeing a surge in Ethiopia's infrastructure needs, and also we are seeing rapid urbanization as well, and that has significantly increased the demand for cement. And I think that Dangote has likely seen this as a huge investment. It's trying to, in a way, solidify or strengthen its existing investment in that sector, in that country, in order to, take advantage of this rising infrastructure needs and also the rising demand for cement. I think it's also in line with Dangote Cement's strategy also to take position also in high growth markets. And I think Ethiopia is also one of the countries that present the prospect of a high growth market, given the fact that we are seeing lots of infrastructure development coming up in that sector. And we're also seeing this also happen across countries in the Pan-African region as well. So I think it's a good one.
Great stuff. Now, we've talked about revenue. Expansions are good, but we do need to talk about costs. So first off, the 62 or is it 63.5% increase in cost of sales. Yeah, that's one. But yeah, I do want you to also speak to this. No, these numbers are gargantuan. The fuel and power consumed, those notable costs, I think that was like in terms of the categories, that was one of the highest. Yeah, 679 billion. Meanwhile, material consumed 411. Can you speak to both of these cost items, and I guess the costs rising by higher than revenues?
Okay, so for 2024, we have seen global energy prices increase, and that has driven the cost on the price of gas and other fossil fuels used for cement production. And because Dangote Cement is energy intensive and it's heavily reliant on these energy inputs, its reliance makes it much more vulnerable to shocks or much more vulnerable to volatility in prices. And also for raw materials consumed, Dangote Cement also imports some of its raw materials like gypsum. and the currency depreciation that we have seen in 2024 also increased the price of these raw materials, and also some components of these fuel and power costs as well. We are seeing gas prices also in USD. So, I mean, all of these factors combined gave a rise to this increase that we saw in cost of sales. The energy pricing increasing, and also the FX evaluation also affecting the price of all of these commodities as well.
Thanks. Great explanation there. I mean, for them, it's essentially to switch to renewables. What can they do to reduce their energy costs?
So currently we are seeing, Dangote Cement has what we call the Alternative 4 project, where they are trying to have like an improved thermal substitution rate. So what thermal substitution rate means is that they are switching out fossil fuels for alternative fuels. And so far we have seen significant progress in that as well. We are seeing Dangote Cement tilt from imported coal to locally produced coal. We're also seeing them tilt to the use of things like biomass or locally sourced or industrial waste as well to power cement production. So I think, I mean, we may not see a lot of, or we may not see this translate into cost savings right now, but in the long term, we'll most likely see a huge impact on its financial performance going forward.
All right. Now, another big cost element was finance costs rising by 125% to 700 billion. So what's the mix there? Loans or what?
Yes, so Dangote Cement is currently exposed to FX loans. And because we saw, like I said earlier, FX depreciation in 2024, that also increased the cost of servicing those loans. And also, we are currently operating in a high-interest environment. As of 2024, we're operating in a high-interest environment. And Dangote also issued bonds and also commercial papers. And both of these factors combined also caused a spike in finance costs for Dangote Cement. So FX loans, high interest rate, and also the new loans that they also issued as of last year for expansion purposes, for working capital purposes. So all of these factors caused an increase in finance cost for Dangote Cement.
Now, I want to talk about the construction sector for Nigeria. We had GDP figures released last week for Q4 and then full year. So we extracted construction, right? So Q4, 2.95% in real terms, real growth. It's down from down from Q4 of 2023. So Q4 2024 versus Q3 2024. That was a 3-month period. For full year, construction 1.14%, down from 3.5%. So, I mean, when you talk about real estate, infrastructure, all these roads we are building and everything, well, what's your sense of construction? And then how does that, I guess, factor for the industrial goods players?
Okay, so 2024 was quite a challenging year for the construction industry. And I mean, for activities in that sector, a crucial contribution is activities from the public sector, that's capex from the public sector, and also real estate activities from the private sector. However, for the public sector, we saw that capital expenditure was quite underperformed in 2024. And that ultimately affected the construction activity that we saw in 2024. And for the private sector, we saw that inflationary pressures has also caused like a weaker disposable income. And we have seen less participation by private agents in that space. So that also affected the growth that we saw in the construction industry. But for 2025, the positive outlook, or the outlook for the construction sector, is basically hinged on how well the government will utilize the capex allocation, because historically capex implementation has historically been low. So we're hoping to see like a major turnaround in 2025, given the fact that we saw a huge allocation for capex in 2025 budget. So we're expecting to see a much more increased capital allocation. We're also expecting to see like the federal government to also prioritize or to create a balance between physical constraints and also fund allocation for capex. And we're also expecting to see some sort of, or given the fact that we're expecting to see inflation taper in 2025, we also expect to see a stronger disposable income for the private sector, and also increased participation in real estate activity, and also translate into the construction growth, hopefully by end of the year. Okay,
so that's optimistic for 2025. But what will, I guess, sustain industrial sector goods players, your Dangotes, your BOA, Lafarge, and the like, as far as going through the year?
So, I mean, a majority of their revenue is hinged on capex expenditure. So, like I said, we expect these capital expenditure like roads, railroads, basically infrastructure development, to feed into cement demand, which also translates into higher revenue for cement players. We're also expecting to see FX stability. So far we have seen stability in the FX market. And given the fact that majority of the sector's costs are FX linked, we expect stability to also feed into their cost and also support profitability. And also alternative energy as well. We are seeing all the players in that sector also make serious efforts to switch towards alternative fuels to reduce operating costs and also to, in a way, shore up their profitability margins. So I think those are the things that would bring more color to what we would expect from the cement players in 2025.
Now, okay, so good. So that's optimistic. Now, what about the stocks of the industrial goods players? Are they, if one is considering them for their wider portfolio, what's the move there?
Yes, so they are very, very, they will make a huge part of a strong portfolio because first, they're fundamentally strong stocks. They also provide long-term capital appreciation for anybody who is holding those stocks or anybody who wants to enter into those stocks. And at the same time, you're also keyed into or you're also exposed to infrastructure development and also economic growth by proxy through those stocks. I mean, it's a win. I mean, I think those stocks are really good for portfolio. They are good to be included in your portfolio for an investor long term.
Great stuff. Abigail, it's always great to have you on the show to talk about the industrial goods sector. Abigail Alabi, Sub-Saharan Africa industrial goods analyst with Vetiva Capital Management Limited. Thank you so much for your time.
Thank you for having me.